Direct comparison between trading styles brings clarity to how traders actually interact with the market. Scalping, day trading, swing trading, and position trading are not small variations of the same approach, but completely different decision-making environments. What changes is not only trade duration, but also execution speed, emotional pressure, screen time, and the type of mistakes traders are most exposed to. Without this clarity, traders often force good ideas into the wrong framework and struggle with consistency. Welcome back to the ComLucro channel. This video is part of our Types of Trading course, where we bring structure and clarity to how different trading styles really work. Scalping demands speed and constant focus. Day trading operates within intraday limits. Swing trading allows trades to develop over days, and position trading focuses on long-term direction. Faster styles increase decision frequency and emotional intensity, while slower styles test patience and conviction. The goal here is not to find the best style, but to understand which one aligns with your routine, mindset, and ability to execute consistently. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Direct comparison between trading styles brings clarity to how different approaches truly operate in the market. Scalping, day trading, swing trading, and position trading are not variations of the same method, but completely different environments with unique demands. Understanding these differences is essential to avoid confusion, inconsistency, and misplaced expectations. Each trading style is defined primarily by time and decision frequency. Scalping requires constant attention and rapid execution, while day trading operates within a single session with structured limits. Swing trading allows trades to develop over several days, and position trading extends that horizon into weeks or months. Results come from choosing a style that matches your ability to manage time, pressure, and uncertainty. Direct comparison also highlights how risk management and psychology shift across styles. Faster styles increase emotional intensity and decision load, while slower styles increase exposure to patience-testing conditions and drawdowns. Entry precision, stop placement, and profit objectives change as timeframes expand. Once these differences are understood, traders stop forcing strategies and start respecting the rules of each environment. Because of this, mixing trading styles without clarity creates internal conflicts and poor execution. A fast style punishes hesitation, while a slow style punishes impatience and overmanagement. When traders ignore these realities, even good analysis breaks down. Direct comparison is not about choosing the best style, but about choosing the one you can execute consistently. One of the clearest differences between trading styles is screen time. Scalping demands constant chart exposure, often for hours without interruption. Day trading still requires extended focus, but within defined sessions and with fewer decisions per hour. Swing trading reduces screen dependency significantly, while position trading requires only periodic review. The amount of time you can realistically dedicate to the charts plays a major role in which style you can sustain. Screen time directly influences fatigue and decision quality. Styles with higher frequency increase cognitive load and accelerate emotional exhaustion if breaks and limits are not respected. Slower styles reduce decision frequency, but require comfort with being away from the market while risk remains open. Neither approach is easier. They simply challenge different aspects of discipline. Ignoring this factor often leads traders to choose styles that conflict with their daily routine and mental endurance. Another key difference appears in how quickly feedback is received. Scalpers experience immediate outcomes, with wins and losses appearing within minutes. Day traders receive feedback within the same session, while swing and position traders wait days or weeks to validate decisions. Faster feedback can reinforce bad habits just as quickly as good ones. Slower feedback demands patience and trust in process rather than emotional reaction. This is why direct comparison matters before committing to a style. Trading is not only about strategy or analysis, but about how often you decide, how long you wait, and how you handle uncertainty in between. When these elements align, consistency becomes possible. When they do not, frustration replaces progress. Risk exposure changes significantly across trading styles. Scalping limits exposure time, but increases frequency, meaning many small risks are taken in a short period. Day trading reduces overnight risk, but still concentrates exposure within a single session. Swing trading accepts overnight and weekend risk, while position trading remains exposed through extended market phases and macro events. Each style carries risk differently, even when position size is adjusted. This difference in exposure directly affects emotional pressure. Faster styles create stress through repetition, speed, and the need for flawless execution under time pressure. Slower styles create stress through uncertainty, drawdowns, and the inability to act while trades fluctuate. One style pressures the trader to act quickly. The other pressures the trader to wait without interference. Because of this, emotional challenges are not eliminated by changing styles. They are simply transformed. Traders who struggle with impulsive decisions may suffer in fast environments. Traders who struggle with patience may suffer in slower ones. Understanding where pressure comes from helps traders avoid blaming strategy when the real issue is psychological mismatch. Direct comparison makes these pressures visible before capital is at risk. It allows traders to choose a style that challenges them in manageable ways rather than overwhelming ones. When emotional load matches personal tolerance, execution becomes calmer and more consistent. That alignment is a key factor behind long-term survival in the market. Execution requirements vary sharply between trading styles. Scalping demands precision under extreme time pressure, where hesitation or delayed entries quickly destroy edge. Day trading still requires timely execution, but allows slightly more room for confirmation and trade management. Swing and position trading reduce execution urgency, shifting focus toward planning accuracy rather than speed. The margin for error changes, but it never disappears. Decision structure also evolves as timeframes expand. In fast styles, decisions are frequent and often reactive, leaving little space for reassessment once a trade is live. In slower styles, decisions are fewer but carry more weight since trades remain active for longer periods. A single mistake can influence results for days or weeks. This changes how responsibility and accountability are experienced by the trader. Because of this, consistency is built differently in each style. Fast trading rewards repetition, rhythm, and strict rules that prevent overreaction. Slow trading rewards preparation, patience, and the ability to sit through uncertainty without changing bias. Problems arise when traders apply the wrong discipline model to the wrong style. Speed-based habits fail in slow environments, and patience-based habits fail in fast ones. Direct comparison helps traders recognize these execution realities early. It clarifies what kind of discipline is actually required before capital is committed. When execution demands align with personal strengths, mistakes become easier to control. That alignment is what allows skill to compound over time instead of being reset by frustration. Lifestyle compatibility is one of the most overlooked differences between trading styles. Scalping and day trading require fixed schedules, uninterrupted focus, and the ability to perform under daily pressure. Swing and position trading offer more flexibility, but demand discipline away from the charts and comfort with holding risk while living normal life routines. A style that conflicts with your daily structure will eventually break consistency. Sustainability depends on how well a style fits into real life, not ideal conditions. Traders with limited screen time often struggle in fast environments, even with solid strategies. Traders who need frequent feedback may feel disconnected and frustrated in slower styles. When lifestyle and trading style are misaligned, discipline erodes quietly over time. This mismatch often leads traders to constantly switch methods. Instead of refining execution, they search for new strategies to solve problems caused by poor fit. The issue is not lack of knowledge, but lack of alignment. Without addressing this, progress resets again and again. Direct comparison helps traders make a conscious choice instead of an emotional one. It shifts the question from what works best to what works best for you. When a trading style fits your routine, mindset, and energy levels, consistency becomes realistic. That is what allows long-term development instead of repeated restarts. At this point, the goal is not to master every trading style. The goal is to understand their boundaries clearly. Each style has rules, limits, and expectations that must be respected for results to appear. Problems begin when traders blur those boundaries and operate without a clear identity. Many common mistakes come from this lack of definition. Scalpers hold trades too long. Day traders turn losses into swing positions. Swing traders manage trades like intraday setups. Position traders interfere with trades because of short-term noise. These errors are not technical, they are structural. Direct comparison exposes these conflicts before they damage performance. It shows why discipline is not just about following rules, but about following the right rules for the right environment. When the environment is clear, decisions become simpler. This is why choosing a trading style is not a preference, it is a commitment. Once a style is chosen, everything else must align with it. In the next part, we will focus on how to identify which trading style truly fits you, based on your routine, personality, and decision-making behavior. Understanding trading styles at this level changes how traders see their own behavior. It becomes clear that inconsistency is rarely caused by lack of knowledge. Most of the time, it comes from operating in a style that does not match how decisions are naturally made. When awareness increases, responsibility replaces confusion. This comparison also removes the illusion that switching styles will fix discipline problems. Every style demands discipline, just in different forms. Speed tests control, slower pace tests patience, and longer exposure tests conviction. Avoiding one challenge only leads to another. Clarity allows traders to stop chasing and start building. Instead of collecting strategies, the focus shifts to mastering one environment deeply. Rules become stable, feedback becomes meaningful, and progress becomes measurable. This is where real growth begins. With this foundation in place, the next step is personal alignment. In the next video, we will move away from comparison and focus inward. You will learn how to identify which trading style fits you best, and how to commit to it with structure and confidence. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.